CF benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Okay, anyone listening, thanks a lot for joining us at the top of our show. This is our latest X Space Live, brought to you by CF Benchmarks. I'm Ken, head of content. As usual, I am joined by Gabe Selby, who's our head of research, and Mark Pilipczuk, who's our research analyst. Hi, gents.
Happy to be here. Thanks, Ken.
Yeah, great to do this.
Brilliant. And we have, as usual, a number of guests. Let's start off with, I believe, who's just joined us, if you can hear us, Ryan Rasmussen, who is head of research at Bitwise. Also, Thomas Perfumo, who is the chief economist of Kraken. Thomas, thanks a lot for hopping on once again.
No, thanks for having me.
Wonderful, wonderful. And also, embarrassment of riches, we have Mr. James Flamant, who is a senior product manager at CF Benchmarks. He's our on-chain, basically, maestro. So, James, thanks a lot for joining us this time.
Yeah, glad to be here. Thank you for having me.
Wonderful, wonderful. So guys, let's start off with what could be top of mind for a lot of people. We just had non-farm payrolls out this morning in the US. And they're quite interesting because the headline was 115,000. That's way above the estimate of 65,000. And more importantly, not only was the unemployment rate steady at 4.3%, this is the second straight month of gains, which apparently, which I didn't realize actually, hasn't happened since sometime in 2024, which is ridiculous. But if that's the case, then it provides a little bit of evidence for some sort of economic event, whether it's a recovery. I don't think that might be a bit too early. But Thomas, how are you interpreting this outcome?
I'm sorry, you cut off me just a little bit. You're talking about the reports from today?
Yeah. So talk about the headline figure, the unemployment, and also the fact that this is the second straight rise in terms of payrolls. Over a couple months.
I'm forgetting my experience on the street like 10 years ago. It's one of those environments where sometimes the market kind of wants bad news because it could be good news, and so it's kind of a mixed bag in the sense that the jobs report came in a lot stronger than expectations. I think doubly so. And the irony is that yes, it's definitely risk assets are trading up on it. I think it really speaks to the moment that we're in right now, which is this conflict with Iran is a global geopolitical conflict, but it impacts the US less so domestically, at least for the time being. The flip side is that it's certainly going to make it even that much harder to justify any change in interest rate policy in the near term. So mixed bag, but I think on balance, of course, positive.
But
domestic
there's
economy.
a little bit of a sense. I mean, from my point of view, that what we could be looking at some sort of artifact. I mean, what do you think? Are these real numbers that sort of speak to the underlying conditions, or are we seeing some sort of the impact of some sort of extraneous effect?
I have been reading some reports about like the breakdowns in it. It seems like health and education were positive, but those have been consistently like the biggest contributor, whereas manufacturing was a bit of a reversal from the March report. And so I think you can definitely read into it that way. The magnitude of the beat makes it less likely that it's how do I put it? That you can pick apart like any specific detail and call it like actually a net negative in my view.
Yeah.
But I would say in general this seems like a beat, and I think it's going to sustain that way.
Yeah, I'd like to maybe share a little bit of color on that, because it's really common to hear economists or practitioners use this quote like one data point is one data point, so you shouldn't extrapolate too much into the future. Well, now we've got, I think, two data points, right? We have the previous month's jobs report which beat, and then we got this month's jobs report that beat. And what I think is interesting is, again, we've had this divergence with the household survey, and then with the kind of the employer survey. So you basically have like the employee survey and the employer survey. And my guess is that it's definitely constructive to see these numbers on the headline NFP reports come out the way they are, beating the expectations. But as what's been a common trend with revisions is that they've been deeply negative when we do the annual kind of employment revisions that the Bureau of Labor Statistics does. So my guess is that divergence in the employee survey versus the employer survey, it's telling me that we should expect probably downward revisions again when we get those later on this year. So what was constructive, like Tomas was saying, is that you're seeing, I think, a little bit of a rotation, a little bit into other categories, other segments of the economy with good jobs growth. Average hourly earnings also kind of tilted a bit dovish in a sense that they weren't too hot, came in below expectations. So that's, to me, kind of there's a little bit of like some risks that this could be a bit noisy still. And I think that we are moving maybe towards that artifact, if you want to call it that, with another data point. Certainly we'll be interested to see how how May's NFP figure, if it kind of continues to beat and kind of confirms this recyclical acceleration in the economy or not.
Yeah. Mark or Ryan, or indeed James, anything to add before we talk about the market reaction or lack thereof?
Yeah, I would just add, hey guys, thanks for having me on here.
Yeah, no worries, man.
I would just add that, in our view, this isn't all that surprising. The economy is in a weird place with the conflict in Iran, but if you kind of zoom out and think about the mega trends that are happening around AI, around crypto, around investment in healthcare, space, et cetera, there's so many positive catalysts that indicate we're in this decade or more long productivity boom. And so I think you're seeing that reflected in this type of data point. I think it makes it increasingly more difficult for Warsh and the Fed, once he is at the chair, to make rate cuts. They're in a bit of a sticky situation, but all data points are starting to point towards the economy is doing fine. And I think you're seeing that reflected in markets. So yeah, I would love to get other folks' takes on how the markets are reacting and pricing that kind of situation in.
I think that's a good point. I think to the point about the markets, it's the cross asset flavor that you saw, around bell opening is you saw NQ get a bid and you saw Bitcoin get offered on it, right? And it's precisely to what Ryan was saying. I think this does make it kind of tougher for doves or for the market narrative of like a dovish Fed regime to take hold with Kevin Warsh once we assume he takes the chairman role. So that obviously kind of has that liquidity beta penalization dynamic for Bitcoin. Meanwhile, NQ, look at the big tech names, they're all being, I think, boosted by this tailwind and strong earnings growth that we've seen. And I think we should probably talk a little bit about that, because there's certainly, I think, nuance there. If you want to kind of highlight, breadth of earnings growth, which is breadth of the price action that you see. You can compare that by looking at something like the equal weighted S&P index versus the market cap weighted S&P index. That ratio of equal weight to market cap weights continuing to make lower lows. So it seems like we talk a lot about the K-shaped economy, where we kind of have like a K-shaped equity market from a fundamental and pricing standpoint. And it's just going to be a matter of like, I think the question is does this kind of eventually, this strengthen the big tech names and these AI dominated themes, does that eventually kind of bleed out into other segments of the market to increase participation? Or do we kind of remain a bit vulnerable from a risk asset standpoint if we see kind of like the AI sentiment sour on either in the near term or later on in the year?
Let's zoom out, just staying within this theme, but zoom out a little bit, and get some perspectives on the fact that the stock market, I mean SPX are probably Nasdaq as well, is in, at the end of this week, assuming we close firm, will be the 6th straight week of gains, which is basically, again, something which we haven't seen since 2024. I'm not sure exactly when in 2024. I'd assume before October. Is this a regime change as regards markets and sentiment, guys?
I mean, it's no surprise that you're seeing all the gains that you are. Just if you think about the weight of the Mag 7 and the total index, and you look at all the earnings growth across the board, you've got it's really strong cloud demand that's bringing a lot of this on. Yeah, they're guiding for some higher capex. So if you look at kind of a free cash flow basis, it's going to go down a little bit over the next year. But it's just, yeah, the demand for compute's real. It's there. And then same thing, if you look at semiconductors, you're seeing on the manufacturer side, them guiding towards higher wafer prices next year. You're seeing the huge demand in memory. So you're seeing higher DRAM prices, which is translating to higher margins for these guys. So it's a combination of revenue growth and margin expansion that's kind of driving this.
Yeah, it looks like we could jump straight to the chip makers if you want, guys, because we had reports from two.
I'll just add one quick thing about the earnings.
Yeah,
It's important to kind of caveat a little bit of how concentrated that earnings growth has been. And in the case of your, big tech names like Amazon, Meta, and Google, they're getting huge boosts from their mark-to-market positions in Anthropic. So if you were to strip that out, depending on the barometer you're using, maybe if you're doing like a mega cap tech weighted index, and you're seeing, I think somewhere around 26, 27% EPS growth this quarter, you strip out those kind of mark-to-market adjustments on their holdings, you see kind of a more in line, like a 15% earnings growth if you adjust for that. So it's still great, it's still strong, and it kind of validates, I think, the thesis that the tech indexes just continue to make new all-time highs. But I think that we have to kind of consider the fact that those mark-to-market EPS push-throughs could conceivably, be a detractor in the future if you were to get that. So I just thought that was kind of something interesting that I was researching earlier.
Yeah. So do we jump straight to? We've got a few key earnings we want to lean into, which does literally tie to this what we've just been talking about. We talk about the chip makers. I mean, it's a bit of a tale of two cities with AMD and Intel, but the reaction by the markets were the same, because of course Intel is on a bit of a upward path, having been almost at the death's door with its with its corporate picture. A new CEO, Lin Bhutan, if I'm pronouncing that correctly. They still reported a quarterly loss, but it's the outlook. They're forecasting a record second quarter. Sorry, not record second quarter. There's a second quarter revenue of 13.8 billion to 14.8 billion, and that's above expectations. And likewise with EPS. I think Mark, maybe you're tracking this sector. This is partly AI related, or maybe are people reading a little bit too much into that for Intel?
Well, Intel's business they got two components. So they have where they design the chips. So they design and manufacture all of the chips. They have both the Intel Foundry Services, where they manufacture everything down to, I believe it's 3 nanometer now or something. It's close to what TSMC could manufacture. It's not as cutting edge. And then the other piece that they have is where they design the actual server chips. And they used to have about a 90% market share in data center. So a lot of that drawdown you saw was them losing most of that market share in CPU to AMD. But I mean, if you look at what we need, it's number of GPUs, both getting them manufactured and plugged in for all the inference demand that's out there right now. So if you have that capacity to do it, your future looks pretty bright. And remember, they started building about 4 or 5 years ago a whole bunch of new chip foundries in the US. So those are nearing completion or hitting completion now. So they should start coming online, and they'll ramp up production over the next coming years. So that makes sense that they're doing so well. And then on AMD's side, where AMD has the real opportunity is in the GPU market. So they have CPU. They got Intel pretty much beat on CPU, but now they're looking to step into GPU and try to take some market share from NVIDIA in the future.
And maybe Tomas, this is clearly a bit of a groundswell that's lifting all boats in, at least in the chip sector. But does it speak to you a little bit like that concentration we've been talking about? Gabe was mentioning that at some point, should there be trouble in that sector, is going to actually take a chunk out of this economic support that we've seen, maybe exemplified by the job numbers we just got. Does that make sense to you? I mean, should we be a bit cautious
Yeah. I
about-
mean,
Yeah.
straightforwardly, if there's any pullback on AI and momentum there, you're definitely going to feel it. I mean, I'd have to look at the latest, but I think the outperformance on the S&P versus the Nasdaq is quite compelling in this case year to date. I think the S&P is let's see, S&P's up. Gosh, I have 8% year to date, whereas the
Yeah.
Nasdaq's up 4.5 percentage points in excess of that, 12.5%.
Wow.
And so,
Yeah.
I do think that if you had a rotation out of AI, if you saw momentum fade, then it would have a tremendous impact, not just on the equity markets, but also on the economy as well. Like the projected amount of investment, CapEx, coming from tech companies. These are companies that 10 years ago, their CapEx spend was nominal. It was nothing. They were like the free cash flow kings. And now they're turning around and they're actually some of the biggest CapEx spenders in the country. On the order of tens of percentage points, like a few tenths of percentage points of the entire GDP of the US is riding on this. And so it is very meaningful. But I think on the flip side, where there was a lot of anxiety and nervousness entering 2026, the big difference is that the models and the improvement in the models are actually living up to their names. I mean, there was a step change improvement in the efficacy of some of these models around December, January, particularly from Anthropic, and it's showing up in the results. And I think, unlike a lot of the doomsday posting around this is .com 2.0, this isn't the same story. It's not like someone just changing the name of their company and the stock goes up 20%. Like these are people selling real products and services and they're getting real traction. Like people are paying for this stuff. So I'm not to suggest that valuations can't come down, but we're in this kind of scenario where if you were worried about the ongoing progress, the progress is actually happening. It's being realized. And the question is, are we a little bit ahead of our skis on the valuation side?
Yeah. Let's real quick before we jump further forward. I wanted to, hover a little bit here. Because in my mind, and for a lot of us, I think all roads still do lead to not just Bitcoin, but crypto in general, right? Because as we've seen today, Ether and Bitcoin left out of the cheer that we got from from this economic news, and that's part of a pattern that we've actually seen for several months. In terms of the quantum of sort of like recovery and just performance of crypto, particularly the large caps, has not matched the broader risk asset complex, if you like. Now, as Gabe has pointed out, one particular reason for that is that something that we can expect to continue? Because what we've got used to in a way in the last several months is Bitcoin performing alongside stocks, Nasdaq particularly. Are we at the end of that particular phase, or what? How do you guys read that?
I'd like to get Ryan's take on that, but I'll quickly just say something that I was looking at the bell opening price very, very closely, just because I thought it was interesting how we were just seeing that bid on the NQ versus how we were seeing just relative weakness in Bitcoin and ETH. You saw that mostly those two pairs mostly be unchanged. And I think it's a discount versus growth rate story. Nasdaq's, of course, influenced a lot by the AI theme, and that's a major catalyst. You were just talking about the chip makers in the last section. These are, these manufacturers have kind of like the dream scenario in a sense that you don't have to have a productivity boom on the manufacturing side to increase your earnings. It's all driven by demand outstripping supply. So all that margin expansion that's hitting the bottom line is just because there's just there's just too much demand for them. There's clearly like a relative shortage in the market. Bitcoin doesn't have that catalyst, and Bitcoin's trading. Like we've been observing in the past few weeks, it had a stronger correlation to tech stocks. That correlation's come off a bit, and you see that with the relative new highs and the way Bitcoin's still kind of I think hovering around that same zone between 78 and 82. So you expect that correlation to come down. I do. I think Bitcoin needs to kind of find its next catalyst and kind of break away from the liquidity beta that gets assigned to it from time to time. These catalysts can certainly come, out of the blue. We've seen how the geopolitical risks sometimes reignite Bitcoin interest and flows, but I know Ryan's also got some good
Definitely.
takes here on this, so I'll pass it over to him.
Yeah, well, I agree that I agree with a lot of what was said here. Like, look, guys, it's a boom. I think that we're here for a magnificent bull market. One thing that I find interesting is that the place to be in regards to crypto this year has actually been in crypto equities and in the miners who have performed extremely well this year. Some of the miners are up triple-digit percents this year. Many are up, 50, 60, 70% over the past 3-6 months. And that's because they're benefiting from this AI boom uniquely given their data centers and the deals they're reaching. I think it was Iron that just reached a deal with NVIDIA yesterday or the day before. You're seeing that reflected in the repricing of these miners as quasi-AI and Bitcoin plays, which I think is really interesting. Stepping back when it comes to crypto assets like Bitcoin, I agree with what Gabe is saying in terms of we've seen Bitcoin grinding. And I think it's actually okay that Bitcoin's been grinding sideways. At Bitwise, we take a lot of time to speak with traditional investors. I was just at a conference yesterday with 100 financial advisors at one of the largest RIAs in the country. And they're still working to get off zero and in terms of allocating to crypto. But one of the questions that I get all the time at these conferences, and we talked about yesterday, is if Bitcoin has such a high correlation to tech stocks or equities more broadly, then is it really a valuable portfolio hedge or portfolio play? Like the industry's been saying, oh, it's an uncorrelated asset for decades. And they see, these advisors see a lot of headlines that say, oh, actually, it's highly correlated to stocks. And that's because when Bitcoin gets coverage, it's typically on days where stocks are booming or selling off, and Bitcoin does have these short-term spikes in correlation, but overall it's a low correlation asset. I bring all this up because I think it's really important that Bitcoin has its own narrative and isn't just rallying alongside the market. And I think that we're starting to see that reflected in the price of Bitcoin over these past few months. It was mentioned that when geopolitical conflict rises, you start to see Bitcoin sometimes act differently than stocks. I think that's good. There's other drivers to Bitcoin than stocks. It's not necessarily benefiting from the AI boom in the same way, right? I think that's good because it gives a reason for investors to pay attention to it and start thinking about it in a broader portfolio construction mindset, which is how a lot of traditional investors, think about allocation. But long term, could not be more bullish on where we're at today in terms of long-term Bitcoin adoption. I know that traditional advisors, traditional investors are getting up to speed. It's a slow grind sideways, but we think it's a slow grind sideways and up from here. Really bullish in the second half of the year. Would love to talk about that, but interested to hear people's thoughts.
Yeah. One thing I'd like to add too on the kind of Bitcoin's lack of performance is we've really seen a shakeup in who the actual market participants are really ever since October 10th. Coinbase reported yesterday, and if you look at the earnings, you can see that the volumes on the spot exchange missed to the downside, and you can see that the consumer segment has really come down in terms of revenues. But if you look at what's growing or what's staying this flat, it's subscription revenues and it's their institutional business that's really picking up. So it's kind of showing us that shift where this was mostly a retail market, more towards institutional participation.
Yeah, it's like the IPO of Bitcoin, Ethereum, Solana via ETFs is playing out or has played out in real time. And you've had this kind of one-time slow transition of early investors. In this case, it's early retail investors and early adopters of crypto. And now it's shifting to long-term oriented, systematic institutional investors. I think, Gabe, you're exactly right. You see that reflected in the earnings profile and growth profile of some of these, centralized exchanges and crypto financial service providers. But that's good in our opinion, because retail is one size and institutional is orders of magnitudes larger, which means we still have a huge amount, element of the market that is going to push crypto higher over the next decade plus as institutions continue to ramp up. You see it in things like stablecoin infrastructure acquisitions, which we continue to see happen to the tunes of multi-billions of dollars. You see it in ETF flows and corporate treasury purchases. All of these things are multi-year tailwinds, and they're huge tailwinds. That's why we're so excited about what's happening.
Yeah, and there's another sort of a stress test of that sentiment as well, Ryan, in strategy, or formerly MicroStrategy, which reported its quarterly earnings recently, and these quarterly earnings on the face of it were absolutely terrible. But it's MicroStrategy, so you do need to inject that sort of element in there. Just the headline, net loss of 12.54 billion. You don't get many companies reporting a net loss of 12.54 billion for the quarter, and their shares basically either rising or at least not falling too sharply, right? Now, the other important stuff with MicroStrategy, of course, is that Michael Saylor, still, CEO, has been basically resetting the mood music with regards to MicroStrategy's key purpose of buying Bitcoin. Infamously, the company has never sold Bitcoin, or never sold very, very strenuously, if at all. But now the signals are coming in that MicroStrategy might at some point sell Bitcoin. Nevertheless, the shares are holding strong. They're actually off their lows of the year, started rising along with the market, along with Bitcoin in early to mid-April, and have basically maintained their most of their gains since then. So let's talk about that, guys. How do you guys read what they reported, what they said, and also their sort of plans for the rest of the year and beyond?
I guess I'll jump in really quickly. I think the loss, the reported loss itself is not really that meaningful. Mostly because everyone already anticipates the loss. There's no mystery to it. I can calculate the change in their Bitcoin value over the quarter. And so the earnings event itself isn't shedding any meaningful news in that sense. It's just an unrealized loss reporting. The interesting thing with MicroStrategy is that over the last year, with the issuance of these new preferred equity vehicles, they've made a very, I would say, explicit effort, but they didn't communicate it well, that they've been trying to transition the capital structure more towards preferred equity and away from the convertible debt. And I'd heard about this more privately, but I think Michael Saylor really went through great length of detail this last earnings call to just explicitly say that he wants to do away with convertible debt. And to me, that is a net positive in the sense that MicroStrategy has always been exposed to this kind of these discrete events where, hey, I have a maturity date for a big bond, or I have a put option date for a big bond. Is Bitcoin price just going to coincidentally be at enough of a high price such that I can convert that bond or that debt maturity into equity? And historically, that's been the case. We haven't really had to test that. And so the big difference here is that by pushing out preferred equity, you change the story from discrete balloon payments, we may owe a bunch of money at this future date, into hey, I'm going to owe regular cash dividends over a period of time. And at the same time, I also have the lever to be able to suspend dividends if I have to, if it's required for me to maintain the solvency of the company. So it brings a lot of control back to the management team away from just random market forces and bad timing. So I think that's a net positive. But the flip side is, because it's going from a balloon payment story or credit story to a cash coverage story, I need to make these dividend payments every so often. He's now got to convince the market that their ability to monetize assets to meet those payments isn't going to crumble the whole underlying asset value. And so I think that was kind of the communication that he was trying to articulate. And frankly speaking, MicroStrategy being the biggest buyer of Bitcoins year to date versus the ETF, certainly, it is net negative, I think, for him to tell you that he may just like put a pause on buying Bitcoin just to prove a point that he can sell it. But
Tomas, is he? I think you guys have been following this much closer than I have, and do you know if he explicitly said like that with this actively managed balance sheet that they would be selling Bitcoin? Like the media has kind of headlined that as an angle, or is it just pausing buys? There's a big difference there, right? Like, of course, you could argue you could be forced to sell,
yeah.
but are you? Is he saying that they just want to be more active in the timing versus like a continuous buy, or is it like no, we're gonna try and time tops and sell it as well?
I didn't get the impression that he's trying to build a trading strategy around it. I think he's trying to build more of a capital like management strategy around the vehicle itself. And so like he presented a bunch of scenarios where, hey, if our multiple on our stock declines to a level where it makes sense for us to sell Bitcoin, we'll do that.
Mm-hmm.
And so and buy back shares. And so it was kind of a first in terms of expanding on that level of detail of their willingness to do something like that. I think people caught onto the headline that he said something along the lines of, maybe we'll just sell some to inoculate the market to prove that we can do it without, causing the market to crash and collapse on itself. And so, but it is a notable tone shift. Like they haven't sold any Bitcoin since the end of December 2020, and they did so for tax reasons, and it was like $11 million worth. But I think him saying that he might sell some and that they have all these like tax losses they can go chase was an interesting development. But at the same time, he did say that it's more important that you buy more than you sell. So trajectory wise, I think it adds volatility to the story rather than directionally creates like a big overhang.
Yeah. Ryan, you want to come in on this?
Yeah. I mean, I think, look, it's interesting. One thing that Tomas said that I think is particularly interesting in the market hasn't really been talking enough about this year is that Strategy has been the biggest buyer of Bitcoin. The fact that Strategy alone, through its issuance of Stretch, has bought billions of Bitcoin, and that's more than the Bitcoin ETFs, is a huge deal. It's, in our view, a big part of what's pushed Bitcoin higher through this recovery back to 80,000. Stepping back, I think it's magnificent that and remarkable that Saylor and Strategy team said we may and probably will sell Bitcoin at some point, and the market didn't even flinch. I think in a absolute bear market scenario, that would have been if they said that when the price was falling towards 60K, I think it would have rattled the market more. But the fact that the market's flat from there, barely moved, is a positive sign, in my opinion. I think it's good that they did this, even if it was to desensitize market participants from the potential shock of Strategy going from never selling to maybe we will sell. So I think that's a positive. They needed to have a way to indoctrinate that into the market that, hey, yes, we said we would never sell, but it's a business, and you can't realistically have a business strategy that always buys and never sells. I think that if they do, will sell a small amount of Bitcoin, probably to show the market that it's not that big of a deal. Of course, the reason they would have to sell Bitcoin right now that everyone's focused on is to cover their dividend payments for Stretch, but they have other ways to cover those dividend payments. They have a cash reserve, which I think they'll continue to buffer. They could generate income on their Bitcoin through options overlay strategies. I don't think they'll do Bitcoin lending because I think that makes it more difficult to underwrite strategy and stretch credit risk. But overall, I think it's a positive that the market's now churned through this news and barely flinched. I think it's a positive de-risking of the market over the long term to no longer worry. What if strategy sells their Bitcoin and it be like this major headline risk that comes out? So net, I think it's positive, but they can't be the only buyer of Bitcoin. It's the reality, and that's where we think ETF flows are going to accelerate through the end of this year and be a big catalyst.
I'll add a little bit of nuance here. If you look at like the flows of ETFs versus MicroStrategy purchases historically, like the all-time highs came during months when ETF flows like well exceeded MicroStrategy purchase activity. And it's because the ETF flows, like they can just better scale versus MicroStrategy fundraising capability. It's just a much more scalable vehicle. And it's much more, broad, diversified interest coming in. Year to date, I agree that MicroStrategy has been a big support vehicle for Bitcoin price, but you'll notice that ETFs, even though they reversed their negative outflows and went positive, they've been consistently a little bit lower than MicroStrategy purchase activity. Well, I shouldn't say a little bit, they've been lower. And what's interesting is that in this last week, to Ryan's point, ETF activity has been really strong. As we bought like $1 billion of Bitcoin this week alone. The interesting nuance here from a trading perspective, if you have MicroStrategy saying that they're going to be a seller, the cool part about their position is that the ETF flows every single day. MicroStrategy is reporting their activity on a weekly basis. And so they have somewhat of an advantage to be able to see whether there's enough strength for them to monetize to do their symbolic sales, if you want to call it that. And so I do think that they're going to be pretty, how do I put it, like disciplined about it and intelligent about it. And they're going to have enough data points and market information to be able to do so without causing a lot of issues.
Yeah, I think that's a great point, Gabe, and agree with that. The other thing and reason why I believe this statement on their earnings call that they may sell the Bitcoin or will sell Bitcoin at some point isn't that shocking, didn't rattle markets that much, is that if you've been listening to Saylor as he's been talking about Stretch more and more on the conference and podcast circuit, this isn't the first time that he's mentioned that they may sell some Bitcoin. I've heard him across several different podcasts over the past few months talk about the fact that at some point they may take advantage of market conditions or tax loss harvest or XYZ in order to help draw down their dividend liability and indoctrinate the industry into the fact that they'll sell some Bitcoin. And so it wasn't that shocking that it was said in the pod or in the earnings call, because he's been talking about this over the past few months. They're like hyper focused on growing Stretch, which I find particularly interesting.
Let's just real quick on this one before we move on. There is another dimension, and you could take the other point of view that here you have this company that is bullish on Bitcoin, basically the most bullish Bitcoin, the company that's the most bullish Bitcoin in the world, essentially. And you've got this signaling that may change its mandate, its stance. Give itself the facility to sell Bitcoin when it needs to, which is a quite radical change considering what we know about Saylor and what we've been told. Essentially, we've been signaled by MicroStrategy as it was, and then of course what Thomas mentioned again, the signaling on the convertible bond strategy to get out of that potential facility, whereby they're not giving themselves this this kind of like implied target on their back, every time it sort of like they issue a new one and it rolls. And then you have this sense that is strategy normalizing, basically coming in from the cold. This sort of financial engineering is being honed down, is being slightly toned down a little bit. And they're no longer going to be this eccentric but brilliant idea that Saylor had and stuck to for many, many years? And could that be have an impact not on just on strategy itself, but of course the fact that you may have an implied buyer, major buyer in the market, no longer on the same footing. Still a buyer, but maybe not as a buyer as much. I think that there's a lot in there, but what do we think of this from the outside looking in? Other investors looking at strategy and saying, well, eventually you had to give in, and now you've given in, and this in a way proves some points.
I think it's a little bit premature maybe to like assign this as giving in. I mean, the timing of it certainly is, you could say, well, it's kind of coincidental because the stretch demand has been so popular that they've issued out a ton of that. And now they've really built this reputation on providing, the stable dividend, which, I heard some folks use this almost as if it's like a money market, alternative, basically to generate, 11% annualized rates versus, whatever the short-term rate is right now. I think that I was at this conference. I was at the Consensus Miami this week. Spoke on a panel with the Ethereum Foundation and Everstake, and it was a really good discussion talking about institutional staking, and a lot of discussion happened to be about these ETFs. And I came across David LeWant, who's the head of research at Anchorage, and we were kind of chatting off to the side. And he had a really interesting take. You can find it on his Twitter feed. Basically talking about the volatility of Bitcoin's its feature, not a bug. And he was tying that to, I think, some research that actually Ryan, your boss Matt Hogan, and him did back in 2023, which was talking about like tax loss harvesting through crypto volatility. And I think it's important to kind of highlight some of these utilitarian features that something like Bitcoin has because of its higher volatility, and it allows you, since there's no wash sale rule, to generate tax losses by just quickly selling it at a loss and then buying it back. So I think having the optionality to at least tell the market it is possible that we could sell our Bitcoin, and certainly selling Bitcoins at a time when your position's down to generate a quick loss, and then you could assumably buy that back immediately and not have to wait 30 days is a pretty powerful feature, right? So it's just I thought it was just an interesting take because it's kind of this we always try to categorize Bitcoin. What is it? Is it store of value? Is it an alternative asset? Is it a commodity? And it's just got these kind of unique features with its volatility and its risk return profile. So I think that's kind of where I'm curious, kind of what Ryan, what you think about that, or if you've seen that research report or not.
Yeah, you definitely. Yeah, shout out David LeWant, who hired me at Bitwise back in 2021, and David's a brilliant guy. And yeah, I'm familiar with the tax loss harvesting analysis that we put together. Look, we're not, I should say, or my compliance team would want me to acknowledge that we're not tax professionals, and this is not tax advice. But there are some interesting elements around tax loss harvesting when it comes to crypto that you mentioned there, Gabe. It's not clear in most cases, how tax loss, like the wash sale application is to crypto, right? Like it's semi-clear, but not entirely clear. What that means, though, for investors is exactly right. You can actually take advantage of crypto, and it's not just Bitcoin, right? It's other crypto assets when it comes to this kind of harvesting losses more efficiently than you perhaps can in other asset classes or with stocks. And that's actually an attractive feature to investors. I mentioned earlier that I spend a lot of time speaking with traditional investors, whether they're financial advisors or family offices, et cetera, about allocating to crypto. And this is a specific topic that's come out a lot over the past couple of months as an attractive feature that these advisors are looking at. And so it's, again, to your point, Gabe, another compelling reason why investors who are thinking about holistic portfolio construction and long-term financial planning will start thinking more and more about how crypto fits into that bigger picture.
Yeah. Let's we've got a few other things we want to touch on as well. We've already MicroStrategy always takes the oxygen out of the room in a good way. But there's been some movement finally on the Digital Asset Market Clarity Act, also known as the Market Structure Bill, depending on which house you ask. Thomas, I know this is your specialism. Would you do us a favor and let us know exactly what happened and also the implications for the bill going forward and when we could see a bit more further movement?
Sure. So I will do my best because I'm not a regulatory expert. But the Clarity Act is the market structure bill in the US. It's really important because it's going to all the kind of, if you want to call it deregulatory or clarifying posture that the regulators have had around crypto in the last year and a half in the US have been extraordinarily positive, but they are temporary in the sense that they are not led they're not cemented in legislative terms. And so this bill is designed to provide that kind of certainty well beyond just any one single administration on how digital asset services can be distributed by different players in the field and what kind of regulatory requirements is associated with that activity. And we've been through quite a whipsaw this year around expectations. If you look at the prediction market odds around the Clarity Act being signed into law in 2026, we've gone from starting at around 3/4 or 75% odds early in January down to, I think, maybe the high 30s, low 40s as of a few weeks ago. And more recently now, we're at over 70% implied odds that we pass this legislation this year. Procedurally, the Senate Banking Committee has been working for several months on draft text for this bill. And the schedule looks like, or based on the reporting, we're looking at possibly receiving a markup as soon as next week with a vote from that committee. And that will kick off the next step in the process, which is reconciling this version from the Banking Committee against the Agricultural Committee and against the House version of the Congress. And that's the next big step of the work that's required. Once you reconcile everything, then you got to get it through some floor votes with the Congress before it lands on the president's desk. And the tricky part is this is an election year. There is a presumed outcome that the Republicans may not control the Congress by November timeframe. And if you don't get it done by then, you may have to restart the whole process. And so there's a lot of pressure to get stuff done, and campaigns are starting to heat up into the summertime. So there's a lot of focus on emphasis on trying to get something done within the next couple of months. But yes, the next step right now that everyone's looking forward to is let's see the draft markup come out of the Banking Committee. And the expectations right now, I believe, are that may happen within the next week or two.
And we saw in the wake of this news a few days, I think it was late last week, some specific stocks that are perceived to be tied to the fortunes of this act. So, like Circle, for instance, jumped like 20% in one session. You could walk us through why that's the case. This is basically to do with the whole idea of how so-called yields are treated. Yep. So why would it be positive for Circle, for instance?
Yeah, so Circle benefited tremendously last year from the Genius Act, which was a legislation around stablecoin issuance. But one thing that's interesting about the growth of USD coin, which is issued by Circle, is that it's really been distributed through Coinbase. And Coinbase made USD coin popular in part because they're able to pay rewards on holding USD coin. And so the consternation has been if there's been plenty of debate around this, if the market structure, which some lobby groups have been pressing for, prevents or restricts the ability for certain players like Coinbase from paying rewards to their customers who hold USD coin, then you may cause people to lose interest in holding USD coin altogether. And so there's been a lot of back and forth around this concept of whether rewards can be paid out within the market structure legislation. And if you look historically at the relationship between USD coins circulating supply versus yields, like the risk-free rate in the US, there is a seeming relationship to it. And you saw this when we had a spike in inflation, a spike in interest rates, and then all of a sudden yield products were on the rise. And in that time frame, early on, USD coin was not paying any rewards downstream to the customers. And the circulating supply fell tremendously versus Tether's supply outstanding, where Tether has a more of like a euro dollar kind of demand driven economy. So USD coin has a bit more sensitivity to this rewards discussion. And so I think straightforwardly, the idea that issuers, or not issuers, rather market participants like Coinbase are able to reward people who participate in USD coin, I think is going to be a favorable environment for Circle. If they lose that, it's going to be disfavorable.
Yeah, we've got still a number of things we wanted to touch on here, and we do have a guest with us who specifically came on to talk about something specific. It's going to be a little bit of a whipsaw, but I want to talk about DeFi and specifically DeFi security. It's a little bit now in the sort of rear view mirror of the biggest hack of the year, which related to a DAO called Kelp, and basically, a sort of a bridging system called Layer 0, if I'm getting that right, James. It appears that the last tally of the sort of losses that were, the losses or the amount that was stolen was something around about 300 million. James, could you quickly refresh our memory of exactly what happened and also why? Because we think it's actually quite important. There's lots of DeFi stuff happening at the moment, and there's going to be a lot more going forward. We think it's quite important to look at the biggest incident in that space because it can actually tell us a lot. So James, if you don't mind.
Yeah, thank you. Yeah, absolutely. So the Kelp incident is quite interesting because it's not just another DeFi exploit. And in this case, it's a clean example of how cross-chain infrastructure contains risk and can impact downstream, in this case, lending markets. And maybe I'll touch it at the end, but also potentially risk, what benchmark rates for on-chain markets. And so what happened was the exploit itself involved, as you mentioned, almost 300 million, big enough for us to talk about it. Effectively what happened, fundamentally the cause of the failure was, as I mentioned, a cross-chain verification. So it wasn't a smart contract exploit. It was when you move asset from one chain to another, it was unichain, I believe, to Ethereum. You need to verify, you basically burn it on one side and create it on the other. And so layer 0 allows you to do that. There's other protocols, Chainlink has something similar, etc. And you need to observe, you need to verify effectively off-chain. And so you have layer 0 that, and Kelp in that instance, when they created it, there was only one instance, only one verifier effectively that would verify that on Unichain it was destroyed and that it was fine to create that RS ETH, which is a restate ETH assets on Ethereum. And the exploit was publicly addressed to North Korean hacking group, and what they did was they hacked the different nodes that this off-chain verification system used, and they also used one or two public nodes that they DDoS, meaning they effectively attacked such that the node was down. And so that verification system only had its two internal nodes to verify that the asset was indeed destroyed on the other chain. And so the smart contract acted as expected. It was more the economical reality that was observed on another chain that was false. And so that allowed the hackers to create more RSETH out of thin air, effectively. And they immediately took those assets, RSETH, and went on Aave, which is the largest lending protocol in DeFi, and actually the largest protocol overall in DeFi in terms of total value locked, and deposit those assets as collateral. There were markets that were accepting this asset as collateral to get, for example, wrap ETH. And so, they walked away with, as you mentioned, almost 300 million of wrap ETH. And that affected the people that deposited wrap ETH that never interacted with RS ETH, but that ended up with our RS ETH collateral that was worth almost nothing. And so from that,
No, just I was going to say, so your wonderful description, thank you. That's the clearest I've actually heard. Within that, you were been sort of hinting at the potential solution or potential ways of creating better safeguards to reduce the risk of that kind of thing happening, because it's important. We have in the States right now an exemption, innovation exemption. I believe it was a rule change the SEC and maybe other parties have now implemented. A sort of an issuer or any kind of entity at will now could actually launch an experiment that enables them to have some sort of bridging, some sort of yield paying protocol within a sandbox. We are now at the stage where some of this stuff could actually be coming into our markets. Of course, it is just a sandbox. It is like a sort of an initiative to enable experimentation. So we're not necessarily saying this is going to come in immediately, but we're now at a closer stage now. So what, in your view, are the safeguards and the sort of mechanisms that could actually reduce this sort of thing, or from the instance of this sort of thing from happening in future, James?
Yeah, and it goes to what we were saying earlier, that also the type of market participant and investors in the crypto market are more and more institutional, and they're looking to see how they can leverage this technology in those markets, and they recognize a lot of the upside, but there's also many of those infrastructure that were perhaps designed to a lower standard, effectively. And I think the sandbox idea is a good idea. Pushes innovation effectively, and we saw another related filing by Nasdaq and New York Stock Exchange to amend general listing standards. So which asset can go into ETF? We'll see if that goes through or not, but that goes to the similar kind of mindset of we want to safeguard investors, but we do want to leave room for innovation. And so that filing by Nasdaq and New York Stock Exchange pertains to effectively allowing ETF to have 15% or less assets that do not yet comply to GSL rules, effectively. So that exploit does ask quite a few questions. How is it that such a big asset, RSETH was about 1.7 billion. It was allowed as collateral, and it was able to be moved across chain with only a single off-chain source of authority.
What's the better architecture? What's the better architecture, basically? I think, we know, but what is your view of the better architecture in that kind of setup?
Well, here it goes. It goes, I think, to it was a system that said it was decentralized, yet there was you're as weak as your weakest point of failure, and here was the cross the bridging, effectively. And so I don't think there's one. I'm not going to be able to tell you what's the one and unique architecture. I wish I had that answer, but I think it's worth, and I think people are going to look at that more and more. What's the weakest, and instead of waiting for hackers to tell us where the weakest link is, for that to be more robust, effectively.
So we're lucky enough to have Ryan. I think Ryan now had to step away for other sort of responsibilities, but let's sort of wind down a little bit now towards the close. We do have a few other things we wanted to talk about. Gabe, do you have anything that's top of mind that you wanted to mention as well?
No, I think we're pushing up here on time, so
yeah,
I'm happy to kind of wrap things up and leave them where they are, unless anyone else has anything else to say.
What are you looking at for next week, or maybe the sort of like near term in terms of your watch points, Gabe? We can talk about that quickly.
Yeah, from a cross-asset point of view, I'm really I'm keeping an eye out on inflation expectations, because we've seen how basically the longer dated crude contracts have started to rise as this kind of Iran situation has not really gotten any clearer. So it was a long story that, it was always like the prompt or the front month contract of these energy futures, whether it's refined or crude futures. You just see that being priced in as a premium, and then the longer dated futures contracts were relatively sanguine and kind of had like a steep backwardation. But now that's starting to kind of change. And I think as the strait continues to stay closed, if those inflation expectations continue to rise, like we saw just now this morning with the consumer report, consumer expectations report, I think we start to see more of a problem with the Fed starting to having to recalibrate heavily towards their inflation mandate. And our base case of having an employment labor market that is relatively weak, that would keep them kind of on at bay of considering raising rates later on down the road, certainly comes more at risk because of that. So I want to keep an eye on kind of the markets there, and seeing if those longer dated futures can be a little bit more tamer. So it seems to change every 24 hours. I don't know. It's just really tricky, but that's really kind of what I'm seeing from a cross asset point of view. Next week on the eco calendar, I haven't actually checked it yet, so I don't know if Tomas, you've got some things that you have highlighted.
What are you looking at, Tomas? Yeah. Just 1 minute each. Thomas, and then Mark, and then James, if you like.
I actually am right up on the same topic that Gabe was mentioning. I've been looking at like the September futures, and we had a breakthrough above like $80 a barrel in the last couple of weeks, and it's been sustained there. And I think it speaks to the stickiness of some of the energy cost rises that aren't snapping back down. So I'm definitely viewing that into like any upcoming inflation data. On the macro front, the only other big stuff next week, we have the confirmation vote for Kevin Warsh. That's going to be a positive, I think. And then, or just at least nice to have it out of the way. And then from there, the June FOMC, which will be the big first meeting for Kevin Warsh coming up. So I don't have any other like harder catalysts that I'm interested in outside of inflation data at this point. But even then, it's almost entirely dependent on what happens with the war. And whether we get a quick resolution or not.
Absolutely. Mark, and what are you looking at for next week?
Yeah, for me, it's a lot of the same with some of the inflation data. We have CPI, PPI, and then we have retail sales to take a look at and see how that's been impacted, if at all, by the war. And then just on the regulatory front, we'll be watching the markup on the bill to see where we are with the Clarity Act, because we are coming up on that Memorial Day recess. So we're going to want to see some movement there before the Senate goes out of session.
Yeah. And I want to be more than polite. James, what is on your horizon in terms of what you focus on, which is, broadly speaking, on chain? Do you want to let us know what you're looking to for the next week or so?
Yeah, no, I think maybe to close it out on that Aave incident, and it does ask questions around interest rates and where to source. Everyone considers Aave USDC lending market to be the risk-free USD rates across the industry, and that was true until, for example, this type of incident happened, increasing counterparty risk effectively, or protocol risk on Aave, and so that kind of reshuffles the way people will benchmark risk-free assets as risk-free, best proxy of risk-free on chain. And so
Exactly.
that will be interesting to see what comes out of it.
Perfect. Guys, you've been listening to CFB Talks Digital Assets Live X Space. We were joined by Ryan Rasmussen, Head of Research at Bitwise, with many thanks to him. He had to go off. You've just been hearing from James Flamant, who's a senior product person at CF Benchmarks. Thanks a lot to you, James. And of course, as always, Thomas Perfumo, who is Chief Economist at Kraken. We really appreciate you coming on board. Mark and Gabe are my close colleagues at CF Benchmarks, who've also been here. Join us again in about a week. Thanks for joining us.
Thank you.
Thank you very much.
Cheers, everybody.
Thank you.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.